This is Macro Horizons, episode 334, The Day the Treasury Thrived, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of July 28th. Having reached the final stretch for this year's Extel Research Survey, polls are still open through August 1st. We'll once again ask for your support and 5-star votes in the categories of U.S. rate strategy, technical analysis, fixed income, and short duration. We truly appreciate your help and feedback. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the biggest developments came in the form of trade deals announced in Washington. The most relevant being the deal between Japan and the U.S., in which tariffs on Japanese imports will be 15% instead of the 25% previously threatened. At the end of the day, this ended up being a net positive for equities, certainly, and left the Treasury market largely trading a range. We're very much on board with the range trading thesis to some extent. The week ahead provides a few challenges in that regard. For the time being, however, the 10-year yield seems to be comfortably anchored to the 200-day moving average, which is effectively 435. The week just past also included another strong takedown for the 20-year auction. This will serve yet again as a counterpoint to the idea that treasuries will soon face a buyer strike. In fact, progress on the trade war, including the deal with Japan and several other deals that have recently been announced, implies that there should be less potential stress and strain for the upcoming auctions. Moreover, Bessent and the Treasury Department have made it clear that they intend to use the bill market to fund deficit spending for the foreseeable future. We have penciled in the first coupon auction size increases in the second half of 2026. Now, in the event that tax revenues end up erring on the side of being higher than expected, it's not inconceivable that Bessent can avoid increasing coupon auction sizes until 2027. That would certainly be a net positive for duration, particularly the 10, 20, and 30-year sectors, which have, at least recently, performed notably well at auction, especially given the outright level of yields and all of the uncertainty triggered by the trade war. We also heard from Powell and Bowman. Comments from Fed officials so close to the FOMC meeting are rare, although given the fact that Powell and Bowman were focused on regulatory reform and didn't speak to the economic or monetary policy outlook, it follows intuitively that the Fed was willing to make that exception. The rhetoric from Washington regarding the potential removal and replacement of Powell before his term expires in May of 2026 was once again topical. Clearly, this is a conversation that is taking place in the White House. That being said, both Bessent and Trump have made it clear that there's no imminent plan to attempt to remove Powell from the Fed. Our take is that the administration's focus on Powell's oversight of the Fed's extensive renovation project is simply politics, not policy.
Well, even though there wasn't a great deal of top-tier information revealed this week, We did have a 20-year auction, a 10-year TIPS auction, and maybe most importantly, the ongoing saga in Washington around the likelihood that there will be a change of leadership at the Fed, either related to the for-cause potential around the renovations to Eccles Hall, or for not-for-cause reasons, as the market continues to grapple with the question of what it might mean to have a shadow Fed chair, or potentially even a new Fed chair earlier than when Powell's term is set to expire next year. Now, while this debate continued with the backdrop of a trade deal with Japan and headlines around a trade deal with the EU as well, this was enough to bring 10-year yields modestly higher, although to call the price action anything other than a consolidation in the current trading zone right around 450.10s would be an overstatement, as investors, like the Fed, remain comfortable in wait-and-see mode.
And it's interesting when we frame the range in the context of some of the macro developments of this year. The lower end of the range comes in at roughly 385, and that was achieved in the middle of April when equities sold off rather dramatically. Now, clearly, equities have rebounded and continue to set fresh record highs. The upper bound of the range, roughly 462.5, was achieved on peak supply stress and anxiety. Now, clearly, the Treasury Department has signaled no intention of increasing auction sizes anytime soon. So the notion that we will challenge, let's call it 465 or 475, becomes increasingly difficult to envision given the broader macro outlook. We remain what we'll characterize as modestly constructive on duration at the moment. That doesn't mean that we're expecting 10-year yields to move back to 3.50 or 3% by the end of the year. However, we are retaining our year-end forecasts for 10-year yields to end 2025 at 3.85. Now, the fact that for all intents and purposes we've already achieved that level reinforces the range trading thesis narrative. Now, we'd be remiss not to acknowledge that some of the cross currents do come in the form of the pressure that the White House is putting on Powell and the Fed more broadly. The prevailing logic holds that regardless of who Trump replaces Powell with, that the incoming Fed chair will be almost by definition more dovish than Powell. The futures market is pricing Fed funds at roughly 325 in June of 2026. So there's an argument to be made, whether it's Powell or the new chair, that by this time next year, policy rates will be back to neutral. What's notable in the shape of the SOFR curve is the fact that it's a gradual decline in policy rates. The spread between the March 2026 SOFR contract and the September 2026 is only 40 basis points. So, said differently, the market is assuming that the Fed will restart the process of normalization sometime this year and continue to deliver cuts in 2026, even if Powell remains at the helm of the FOMC. This market pricing seems to be somewhat at odds with the barbell narrative, i.e., Powell continues to hold until the Fed is convinced on the data front, or the incoming Fed chair delivers 75 or 100 basis points worth of rate cuts at the June 2026 meeting. If nothing else, both outlooks imply that anytime 2-year yields get close to 4%, that will be a compelling buying opportunity.
And there's another factor to consider as well, given what we saw in risk assets this week and the S&P 500 making new all-time highs, with risk assets more broadly continuing to perform well. Part of this is obviously predicated on the idea that rates will eventually be coming lower, and also the backdrop of tariff impacts that maybe are not as bad as initially feared, a labor market that is still resilient, and a growth outlook that has weathered the uncertainty to start the year in relatively good shape. From a financial conditions perspective, what the decline in volatility, both in rates and in equities, means for financial conditions is that the market has re-entered the mode of doing some easing for the Fed. Whether it's through the wealth effect specifically or consumer and corporate sentiment more broadly, the fact that equity markets remain so resilient in the face of all the geopolitical and economic uncertainty out there means that even if the Fed is a little bit more worried about the labor market than might meet the eye, the fact that financial conditions are continuing to ease reinforces the idea that the Fed certainly isn't cutting next week. Frankly, it's unlikely they're going to be cutting in September, and maybe there's even a case to be made for the next cut to be pushed all the way into 2026. Based off the rhetoric and the politics, it's probably too soon for that to be a base case, but if one looks solely at the performance of the S&P 500, it hardly points to a backdrop that suggests the Fed needs to be in a rush to remove monetary policy restriction.
And in keeping with the idea that there is a path for the Fed to remain on hold until 2026, it's not lost on us that the futures market is still pricing in 45 basis points worth of rate cuts by the end of the year. So this implies that while September might be a difficult base case, if the market's current pricing is realized, then moves in October and December should be penciled in, at least until the market is convinced otherwise by the incoming data. And Ben, to your point about the ongoing performance of the equity market easing financial conditions, that most certainly has been the case, and it has also lowered the probability of a recession in the next 12 months, as well as potentially contribute to the stickiness of realized inflation. That's been a concern of ours, as well as the market and monetary policymakers, as the U.S. is poised to see an increase in goods inflation during the coming months. Now recall, as we saw in the June CPI release, core goods, excluding autos, increased in June the highest amount since November 2021. Our baseline expectations are that this trend will continue in July, August, and potentially September before we start to see the initial round of tariff-related inflation start to ease as the data cycle gets into Q4. With this backdrop, one might think that the continuing outperformance of the equity market would make it difficult for Treasury yields to drift below 4%. However, when looking at the price action that immediately followed Liberation Day, it was effectively the sell U.S. assets trade. Now, to some extent, obviously in the stock market that has reversed, but we have yet to see that sentiment really translate through to Treasuries. Treasuries at this point now have convincingly avoided a buyer strike. The dollar is still at or near its lows, and that suggests that, frankly, with 10-year yields in a range of 425 to 450, it's a pretty good buying opportunity, all else being equal.
And as the latest example of that, one doesn't need to look any further than the result we saw for this week's 20-year auction. Despite 20's relative richness on the curve versus 10s and 30s, as speculation around the potential for increased buybacks has increased, and in outright terms, 20-year yields that had dropped almost 16 basis points off their local highs, what we saw was the largest stop-through since June of last year and underlying bidding statistics that reinforced, even though valuations weren't all that compelling and there wasn't a great deal of a concession for the least loved Treasury security, there's still plenty of demand for duration at these levels. Part of that has to do with Secretary Bessent's success in laying the groundwork for bills to account for more of a total percentage of the market going forward, let's call it somewhere between 22 and 25%, although next week's refunding announcement will be closely watched for any greater clarity in that regard. But the bearish bond vigilante arguments that were cited in driving the bear steepener trade that came out of the election have now become far less pronounced as it's become clear that both Bessent and Trump are going to be reluctant to increase long-end auction sizes. This, combined with the potential for a larger buyback program to be announced next week, has benefited the longer end of the curve, and whether or not it's a shadow operation twist, it's clearly inspired more comfort for buyers of the long end, even at levels that are off the latest cheap extremes.
And reinforcing this argument is the fact that the progress on the trade war front has progressed as the August 1 deadline looms. Another takeaway from the last several weeks of trade war maneuvering and deals and announcements is that while the market is perhaps appropriately focused on the August 1st deadline, the reality is even if the administration follows through with the vast majority of the new tariffs announced, there's still plenty of room for bilateral agreements later this summer that simply reverse the new levels that come into effect in early August. Said differently, we're interpreting the letters that were sent by the administration to the U.S.'s major trading partners as simply another form of negotiations as opposed to the most extreme and final decision.
And I'd like to think that enclosed in these letters is, of course, a copy of The Art of the Deal. Signed, obviously.
By who? Bessent? In the week ahead, The Treasury market will once again have an array of incoming information from which to hopefully derive some type of trading direction. We say hopefully because we have been in a range for quite some time in the 10-year sector, and we do expect that the fundamental relevance of the information on offer in the week ahead will lead to a breakout in one direction or another, either higher rates or lower rates. We're biased towards a rally, but we'll concede it will be a function of the combination of the realized economic data, the FOMC, and the refunding announcement. Starting on the supply side, the Treasury Department has a busy week ahead. Monday, we have both the 2- and 5-year auctions, 69 billion 2s on Monday morning and 70 billion 5s on Monday afternoon. That's followed by the last auction of July, which will be Tuesday afternoon's 44 billion 7-years. We also have on Monday afternoon the Treasury Department's financing estimates, which will set the tone for the refunding announcement. Now, regardless of how the financing estimates come in, we do not expect coupon auction sizes to change for the upcoming refunding. Within the refunding process, the market appears to have come to the consensus that the liquidity buybacks will be increased from 30 billion a quarter to 60 billion a quarter. Now, some estimates are as high as 75 billion a quarter, but at the end of the day, this will be, and appropriately so, viewed as a shadow operation twist because all of the borrowing to increase buyback sizes will occur in the bills market. Let us not forget that out of Washington, we'll also hear from the FOMC. No change is expected to the policy rate. And given the lack of an update to the SEP and the beloved dot plot, the market will be left to trade off of the combination of the statement and Powell's press conference. We're anticipating that the theme will remain the same, and that will be one of patience and waiting to see how the trade war ultimately impacts the real economy. On the data front, we have Tuesday's JOLTS release, which has historically been associated with sharp price action in the Treasury market. We also have the first look at Q2 real GDP. Currently, the consensus is for a 2.5% increase, and within the details, we'll be looking at the overall health of the consumer. Recall that consumption in Q1 was revised lower after an initially strong print, and when combined with the real personal spending figures from April and May, it goes without saying that Q2 consumption is without question the wild card of the week. Now, we'll also see payrolls on Friday, which could further refine the market's expectations for the September FOMC meeting. However, given the surprising resilience that we've seen on the labor front, it's difficult to push back against the consensus, which is for 110,000 jobs added in July and a slight increase in the unemployment rate to 4.2%. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And on the topic of condolences, this will be our last appeal for votes in the Extel survey. Until next July. And the next. And the next. And the next. Although that implies a lot on the employment front. But hey, we're optimistic. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.